What does $5 billion really look like on paper? Not headlines, not rumors, but exact numbers. 69 bank accounts, hundreds of millions in cash, a $484 million loan backed by art hanging quietly on a wall. This isn't a movie script, it's a financial ledger, line by line. And when government documents open the door just a little, you don't just see wealth. You see structure, leverage, risk, protection. You see how power is organized. And the question becomes, if this is how one billionaire moves money, what does it tell us about the system the rest of us live inside? Stay with me, because what comes next changes how you look at money forever. Welcome to Market Metal. If you're someone who has watched markets rise and fall over decades, someone who understands that real knowledge comes with time, then you're exactly who this channel is for. Before we continue, take a quiet moment and subscribe. Not for noise, but for clarity. And tell us in the comments, where are you watching from today? The Ledger. What the documents actually show. When financial historians study wealth, they do not begin with headlines. They begin with structure. In the recent release of government documents connected to the Epstein Files, something rare appeared. Not gossip, not commentary, but financial detail. Within those pages, the architecture of a $5 billion fortune became visible. For serious business minds, this is not about scandal. It is about structure. It is about how capital is arranged, protected, and mobilized. The documents describe the finances of Leon Black, the former chief executive of Apollo Global Management. They outline specific balances, account placements, and loan arrangements. For most entrepreneurs, wealth exists in a few accounts. One operating account, one savings account, perhaps an investment portfolio. But here, the documents show 69 separate bank accounts. This number alone changes the conversation. Why would a billionaire need 69 accounts? The answer is not complexity for its own sake. It is risk management. Ultra-high net worth individuals do not treat liquidity as a single pool. They fragment it. They distribute exposure across institutions. If one bank faces legal, operational, or reputational stress, the entire fortune is not frozen. Liquidity remains functional. This fragmentation strategy is rarely visible to the public, yet in these documents it appears clearly. Each account has a purpose. Some hold operating cash. Some are linked to investment vehicles. Others may serve estate planning functions or tax positioning strategies. Together, they create a liquidity grid rather than a single reservoir. The files also reveal approximately $154 million in cash. For an individual worth billions, that amount might seem small, yet it is significant. Cash is optionality. It allows movement without liquidation. It allows negotiation from strength. It prevents forced selling during downturns. In most business failures, the cause is not lack of profitability. It is lack of liquidity. A company may be valuable on paper, yet collapse when short-term cash dries up. Billionaires understand this deeply. They structure liquidity first, growth second. One of the most striking details in the documents is a $484 million loan backed by art. This is where the structure becomes even more instructive. Fine art, to many, appears decorative. To ultra-wealth, it is collateral. It is a financial instrument. By borrowing against art, the owner avoids selling it. Selling would trigger taxes, disrupt portfolio positioning, and reduce long-term asset exposure. Borrowing preserves ownership while creating liquidity. The art remains in place. The capital becomes mobile. This is a critical distinction. Middle-class leverage is often income-based. Banks lend against salary or projected revenue. Billionaire leverage is asset-based. They borrow against appreciating assets, not future wages. This reduces risk and improves negotiating power. For entrepreneurs watching this structure, the lesson is not to replicate it immediately. The lesson is to understand hierarchy. At the top level of wealth, assets produce liquidity without being surrendered. That principle reshapes how one thinks about ownership. The documents also reveal how loans are structured in scale. A $484 million loan is not taken casually. It requires sophisticated valuation, trusted institutional relationships, and legal engineering. It implies long-term planning rather than short-term speculation. This is where the wealth historian approach becomes useful. He studies patterns across centuries of capital. One pattern remains constant. Durable wealth protects itself before it expands itself. Liquidity is layered. Exposure is segmented. Leverage is controlled. The 69 accounts represent segmentation. The art-backed loan represents controlled leverage. The cash reserves represent optionality. Together, they form a defensive architecture. For young entrepreneurs, this structure may feel distant, yet its relevance is immediate. Economic cycles are tightening. Credit conditions fluctuate. In volatile periods, those with single-channel liquidity often face forced decisions. They sell assets at poor prices. They accept unfavorable terms. They lose negotiating power. By contrast, diversified liquidity allows patience. Patience converts volatility into opportunity. This is how capital compounds through downturns. Another subtle point emerges from the documents. Transparency of wealth structure is rare. Most billionaires' finances remain private. When documentation surfaces, it becomes a case study. It shows how capital is organized in reality, not theory. It also separates narrative from mechanics. Public discourse often focuses on personalities, but wealth survives personalities. Structures endure. Legal entities, trusts, diversified accounts, and collateralized borrowing do not rely on public approval. They rely on design. The files further show the scale of advisory involvement. Such structures are not self-built casually. They require accountants, legal architects, estate planners, and banking institutions aligned in coordination. Wealth at this level is a managed system, not a collection of accounts. For business leaders, this is a warning. Many founders concentrate everything into their company equity. They operate with minimal separation between personal and corporate risk. When the cycle turns, both collapse together. The billionaire model separates exposure. Business risk remains contained within corporate entities. Personal liquidity remains diversified. Asset collateralization provides flexibility. Each layer acts as insulation. There's also an educational contrast here. Most people measure wealth by headline net worth. But net worth is static. Structure is dynamic. A $5 billion figure tells nothing about liquidity quality, risk insulation, or leverage exposure. The documents begin to answer those deeper questions. The presence of multiple institutions also implies strategic banking relationships. Banks compete for high-value clients. In competitive environments, terms improve, access expands. This dynamic is invisible to smaller operators who rely on a single lender. The files do not simply show numbers. They reveal philosophy. Wealth at scale is engineered. It is not accidental. For the serious business audience, this is not a story about controversy. It is a financial blueprint. It shows how liquidity is distributed, how assets are monetized without liquidation, and how leverage is applied without destabilizing the base. In uncertain economic climates, these lessons gain urgency. Credit tightening affects mid-tier entrepreneurs first. Interest rate shifts alter refinancing conditions. Asset volatility pressures concentrated portfolios. Those who study structure early can adapt before crisis forces adaptation. The 69 accounts are not excess, they are insulation. The art-backed loan is not indulgence. It is capital efficiency. The cash reserve is not idle. It is strategic optionality. For young founders building their first serious enterprise, the question becomes clear. Is their capital structured for survival or only for growth? The documents offer an unusual glimpse. Rarely does the public see the ledger of a $5 billion fortune. When it does, the intelligent response is not outrage or fascination. It is analysis. Structure precedes resilience. Liquidity precedes expansion. Segmentation precedes durability. And in every economic cycle, those who understand the sequence are the ones who remain standing when volatility passes. This is why it matters now. The strategic playbook of billionaire risk management. If part 1 revealed the ledger, part 2 reveals the intention behind it. Numbers alone do not create power. Structure does. And when observers look carefully at the financial architecture described in the documents, they begin to see something deeper than wealth. They see a defensive system designed to survive disruption. The first layer of that system is compartmentalization. For most entrepreneurs, risk is concentrated. Their income, equity, credit lines, and reputation are tied to one primary business engine. If that engine slows, everything feels the pressure at once. Cash tightens. Lenders hesitate. Options shrink. Billionaire structures operate differently. When capital is spread across dozens of accounts and institutions, no single point of failure can destabilize the entire system. If one institution freezes, others remain active. If one asset class declines, others hold liquidity value. If one relationship deteriorates, others provide leverage. This is not paranoia, it is design. Compartmentalization creates what financial historians call a risk firewall. Each segment absorbs stress independently. Shock does not travel freely across the entire structure. In volatile markets, this difference becomes decisive. The second layer is collateral optimization. The documents reference a $484 million loan secured by fine art. To some, this appears extravagant, but to strategic capital operators, it is precision engineering. Instead of selling a valuable asset and triggering capital gains taxes, the owner borrows against it. Ownership remains intact. Appreciation potential continues. Liquidity is created without liquidation. This is a principle few small business owners understand early enough. Do not sell core assets to solve temporary liquidity needs. Monetize them intelligently. Asset-backed borrowing shifts the conversation. It turns ownership into leverage while preserving control. It creates cash flow without surrendering position. But there's a deeper insight here. Debt, at this level, is not desperation. It is strategy. In lower tiers of wealth, debt often represents pressure. Credit cards, emergency loans, high-interest obligations. It narrows freedom. At higher tiers, structured debt expands flexibility. It becomes a tool to maintain asset continuity while unlocking liquidity. This distinction is fundamental for young entrepreneurs. They must understand that leverage itself is not dangerous. Misaligned leverage is dangerous. Borrowing against unstable revenue streams is fragile. Borrowing against appreciating tangible assets is controlled. The third layer of billionaire risk management is timing. Large fortunes are rarely reactive. They anticipate refinancing cycles, rate shifts, and institutional behavior. When they negotiate loans, they do so from a position of surplus liquidity, not deficit. This is a subtle but powerful difference. Most small businesses seek funding when they urgently need it. Billionaires secure funding when they do not. This changes negotiating power dramatically. Terms improve, covenants soften, flexibility increases, liquidity attracts liquidity. And this leads to a critical warning for the entrepreneurial audience. Economic cycles are tightening globally. Credit conditions shift faster than many founders expect. When banks become cautious, they first reduce exposure to mid-tier borrowers. They reassess risk, they shorten terms, they tighten covenants. Those with layered liquidity survive quietly. Those with single-channel exposure feel the shock immediately. The documents also reveal something important about insulation from reputational volatility. Controversy can impact public perception, but well-structured capital does not collapse because of headlines. Segmented accounts, diversified institutional relationships, and asset-backed loans operate independently from public narratives. This is not about ethics, it is about mechanics. Capital systems at scale are designed to withstand noise. Entrepreneurs often underestimate reputational risk. They tie personal branding, business performance, and financial exposure into one interconnected structure. When stress hits one area, the entire system shakes. Billionaire architecture separates these channels deliberately. Another powerful lesson emerges from the role of advisory networks. Complex financial structures require coordination. Estate planners, legal experts, banking executives, tax specialists, they function as an ecosystem. Each component strengthens the whole. This network effect compounds over time. Institutional memory develops, negotiating leverage improves, crisis response accelerates. Young entrepreneurs frequently operate alone or with minimal advisory input. They delay structural planning until after growth. But by then, exposure has already concentrated. The wealth historian method teaches a simple truth. Resilience must be built before visibility increases. The larger the fortune, the more invisible its protective layers become. Outsiders see art collections, private equity holdings, or public net worth estimates. They rarely see the segmentation strategy, the liquidity grid, the asset-backed borrowing design. Yet those invisible layers are what allow wealth to endure generationally. There is also a psychological element. When liquidity is diversified and insulated, decision-making becomes calmer. Panic decreases. Short-term volatility loses power over strategic thinking. That composure itself becomes a competitive advantage. In contrast, entrepreneurs with thin liquidity buffers make decisions under pressure. They accept unfavorable deals. They dilute equity prematurely. They sacrifice long-term ownership for short-term survival. The strategic playbook revealed in the documents is clear. Segment exposure. Monetize assets without surrendering them. Secure credit before you need it. Build advisory depth early. Separate reputation risk from capital risk. These principles are not theoretical, they are observable. And the urgency lies here. Global capital conditions are entering a period of recalibration. Interest rate regimes shift, regulatory frameworks tighten, institutional banks reassess exposure models. Those who treat liquidity casually will learn the hard way. Those who study structure early will navigate cycles with stability. The story, then, is not about one billionaire's balance sheet. It is about the contrast between engineered wealth and exposed ambition. The ledger shows the design. The risk management playbook explains the survival. And for every founder watching this briefing, the silent question remains, is their financial structure designed for growth alone, or for survival when growth pauses? Power, networks, and the architecture. Behind the fortune. By the time observers move beyond the numbers, a deeper pattern begins to emerge. The documents do not only show balances and loans, they reveal something more powerful. Access. At high levels of wealth, capital does not operate in isolation. It operates within networks. And networks determine velocity. The $5 billion structure described in the files did not appear through personal effort alone. It is supported by layers of advisors, institutions, and financial engineers. This is not accidental. It is strategic. When the wealth historian studies the rise of enduring fortunes, he rarely finds a lone operator. He finds systems. He finds coordination. He finds information flow. Information is the first advantage. Large-scale capital moves with early signals. It anticipates regulatory shifts. It understands tax law adjustments before they become public debates. It prepares for rate changes before smaller players feel their consequences. Entrepreneurs often respond to economic news. Billionaires position ahead of it. This difference compounds over time. The documents indirectly show the level of advisory involvement required to manage dozens of accounts and structured loans. Such arrangements demand legal precision, estate planning sophistication, tax modeling, and institutional trust. Access to elite advisory networks changes everything. A young founder may rely on one accountant and one banker. A billionaire operates with coordinated teams across disciplines. When one variable changes, interest rates, asset valuations, compliance standards, the network adjusts collectively. This creates resilience beyond liquidity alone. But there is a second layer that deserves attention: institutional access. Large fortunes negotiate from strength. Banks compete for their deposits. Lending institutions offer tailored credit structures. Investment firms propose exclusive vehicles. Terms improve with scale. This is not favoritism. It is economics. Capital flows toward stability. When a financial institution sees diversified liquidity, asset-backed collateral, and long-term relationships, it perceives lower risk. Lower risk produces better terms. This is why understanding structure matters for entrepreneurs. Institutional trust is earned long before it is needed. The documents also illuminate something rarely discussed openly: asymmetry. There is asymmetry in information. There is asymmetry in access. There is asymmetry in engineering capacity. An entrepreneur borrowing against projected revenue carries performance risk. A billionaire borrowing against fine art or diversified holdings carries valuation risk, but not operational survival risk. The difference is structural insulation. This creates what economists call capital velocity advantage. Large fortunes can deploy funds quickly during downturns. And when markets tighten and assets decline in price, those with liquidity reserves acquire. Those without liquidity defend. History repeats this pattern consistently. During financial crises, mid-tier operators sell under pressure. Top-tier capital buys under discipline. The documents provide a rare glimpse into how that discipline is constructed. Another element emerges quietly: legal layering. Complex wealth structures are rarely held in one personal name. They are placed within trusts, entities, and structured vehicles. This creates jurisdictional flexibility and estate continuity. It also reduces concentration risk. Entrepreneurs frequently delay entity structuring until scale demands it. By then, exposure is embedded. Adjusting later becomes expensive. The strategic lesson is clear. Legal architecture should evolve alongside financial growth, not after it. There's also a cultural insight hidden within these structures. Large fortunes are not emotionally reactive to market shifts. They operate on long horizons. This patience is supported by liquidity depth and diversified exposure. When cash buffers are strong, decision-making becomes strategic rather than urgent. Urgency is expensive. When an entrepreneur must act immediately due to cash pressure, negotiating power declines. When a billionaire can wait, negotiating power increases. Power often belongs to the patient. The documents also reflect the ecosystem of private equity, institutional capital, and asset management relationships. These networks amplify opportunity. Access to high-level deal flow, private placements, and strategic investments becomes normalized. Entrepreneurs outside these circles often believe opportunity is random. In reality, opportunity is frequently networked. This is not a complaint about inequality. It is a recognition of structure. Understanding elite financial architecture is not about envy. It is about preparation. If a young founder intends to scale, he or she must eventually operate within institutional frameworks that requires credibility, governance standards, audited transparency, and structured liquidity. The blueprint revealed here shows that wealth is not merely accumulated. It is engineered to interact with institutions seamlessly. There is also a warning embedded in this architecture. The broader financial system is not neutral in design. It rewards structure. It penalizes concentration. It favors those who prepare before volatility arrives. When regulatory or market turbulence emerges, those with institutional integration adjust quietly. Those operating independently feel the shock more visibly. This is why serious decision makers study cases like this. They do not focus on personality, they analyze architecture. The 69 accounts are not excess complexity. They are redundancy. The art-backed loan is not indulgence. It is capital preservation through leverage. The advisory network is not luxury. It is operational defense. For aspiring businessmen and founders, the suspense lies in this realization. The system is structured for those who understand structure. If liquidity is centralized, risk compounds. If leverage is misaligned, flexibility disappears. If advisory depth is thin, blind spots expand. And as economic conditions recalibrate globally through interest rate shifts, regulatory scrutiny, and geopolitical pressure, those blind spots widen. The hidden advantage of elite capital is not merely size. It is preparation. This part of the story moves beyond the ledger. It enters the realm of systemic positioning. Those who study this architecture early can build toward institutional strength gradually. Those who ignore it often encounter painful corrections. Power, in financial terms, is rarely loud. It is layered. And within the documents, those layers become visible. The question for the entrepreneurial audience is no longer what happened. The question is whether they are building their own structure to withstand what happens next. The systemic warning: what entrepreneurs must understand now. By the time the final page of the documents is examined, the lesson becomes larger than one individual. It becomes systemic. The files do not simply reveal a $5 billion fortune. They expose the structural gap between engineered wealth and exposed ambition, and that gap is widening. For entrepreneurs and business leaders, this is not background information. It is a forward-looking warning. The first and most urgent principle is this: liquidity is power. Revenue creates growth. Profit creates stability. But liquidity creates survival. When markets tighten, suppliers demand faster payments, lenders reassess risk, and investors pull back. Only liquidity determines whether a business stands or falls. In the documents, liquidity is segmented, diversified, and insulated. It is not left vulnerable to a single institution or single credit line. That design provides maneuverability during stress. Most mid-tier entrepreneurs operate differently. They centralize cash into one primary bank. They rely on one lender. They assume continuity. When disruption arrives, they discover how fragile centralization truly is. Economic history confirms this pattern repeatedly. During financial contractions, small and mid-sized enterprises fail not because they lack customers, but because they lack liquidity buffers. Credit evaporates quickly. Refinancing becomes expensive or unavailable. Operational pressure accelerates. The strategic warning is clear: liquidity planning must occur before tightening begins. The second principle is asset-based leverage versus income-based leverage. The documents describe borrowing against tangible assets, not future earnings. This distinction is critical. Income-based borrowing depends on performance stability. If revenue slows, leverage becomes heavy. Asset-based borrowing depends on collateral value. If structured conservatively, it preserves flexibility even when cash flow fluctuates. Entrepreneurs often use personal guarantees tied to business income. This creates concentrated risk. If business slows, personal exposure increases simultaneously. The elite model separates exposure. Corporate entities absorb business volatility. Personal assets remain diversified and insulated. Collateral is strategically chosen. This separation is not accidental. It is defensive engineering. The third principle involves structural fragility within the mid-tier wealth bracket. Entrepreneurs building wealth often experience rapid growth. They scale operations, expand teams, and increase fixed costs. Yet many fail to scale financial architecture at the same pace. They upgrade offices before upgrading liquidity design. They increase revenue before diversifying banking relationships. They expand valuation before insulating risk. When macroeconomic shifts occur, interest rate increases, regulatory tightening, market volatility, the imbalance becomes visible. The systemic environment is currently recalibrating. Credit conditions fluctuate, capital becomes selective. Institutions prioritize stability over expansion. In such environments, exposure becomes visible. The documents serve as a mirror. They show how durable capital structures are layered before volatility emerges. They do not react to instability, they anticipate it. There is also a psychological layer to this warning. Entrepreneurs are trained to pursue growth aggressively. Growth attracts attention. It validates ambition. But structural resilience is quieter. It requires discipline. It requires allocating capital to protective layers that may not generate immediate return. Yet resilience compounds silently. When others retrench, resilient operators deploy. When valuations decline, liquid capital acquires. When competitors struggle, insulated firms expand. This is how generational wealth is built, not only through expansion, but through survival across cycles. The final and perhaps most important insight is systemic design. The financial system rewards those who understand institutional alignment. It rewards diversification, legal layering, and strategic banking relationships. It penalizes concentration, informality, and reactive financing. The documents reveal how one large fortune interacts seamlessly with institutions, banks, advisors, asset managers. This integration creates continuity even amid controversy or market turbulence. Entrepreneurs who remain structurally informal face institutional friction when scaling. Credit committees hesitate. Investors demand restructuring. Negotiations become reactive rather than proactive. The warning then is not about personality or public narrative. It is about preparedness. If economic tightening intensifies within the next cycle, exposure will surface quickly. Those with thin liquidity buffers and concentrated leverage will feel pressure first. Those who engineered insulation early will navigate with control. This moment matters because structural transitions rarely announce themselves loudly. They emerge gradually, through tightening credit spreads, slower refinancing approvals, subtle covenant adjustments. By the time headlines declare contraction, disciplined operators have already repositioned. The documents offer more than financial curiosity. They offer an instructional framework. Segment liquidity. Diversify institutions. Separate personal and corporate exposure. Use asset-based leverage conservatively. Build advisory depth before scale demands it. These are not abstract principles. They are observable in practice. For aspiring businessmen and young entrepreneurs, the urgency lies in timing. Structural discipline implemented early compounds advantage. Structural neglect compounds risk. Economic cycles will continue. Volatility will return. Regulatory frameworks will evolve. The difference between those who survive and those who retreat will not be ambition. It will be architecture. The $5 billion ledger is not merely a disclosure. It is a demonstration. And for every serious decision maker studying it, one conclusion becomes unavoidable. Wealth is not defined by size. It is defined by structure,